Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
Welcome back to the Deep Dive. Today, we're tackling something I know you're keen to understand better: property valuation.
Oh, yeah. It's a big one.
You bet. And you've sent over some seriously interesting stuff, especially these excerpts from, 5 property valuation methods you may not know about.
Yes, that's a good one. Lots to unpack there.
For sure. So we're going to break down these 5 methods, but also the article talks about things you need to think about before you even buy a property, right?
Absolutely. Crucial consideration.
Yeah.
Can't just jump into the numbers.
Exactly. So we're going to uncover all that, and I think there are going to be some real aha moments for our listeners today.
Definitely. It's amazing how much goes into figuring out a property's worth.
Right. So the article kicks off with this advice. Before you even think about valuations, look at the building itself, its design and flexibility.
Right. Is it adaptable? Can it change with future needs?
Makes sense. A building that can be easily reconfigured, maybe even repurposed down the line, that's going to hold its value much better.
Absolutely. Lower risk for the investor.
And then there's location, which, obviously matters, but the article digs deeper than just good neighborhood, right?
We're talking accessibility, parking, loading facilities if it's commercial. All those practical things can make or break a deal.
Totally. And then there's lease terms. The article lays out this ideal: modern institutional lease, 15 to 25 years, upward-only rent reviews every 5 years, tenant covers most costs. But is that realistic?
Well, in reality, it's all negotiation, isn't it? You got to grasp the different types of rent reviews, how they impact your return. Upward only protects the landlord, but a turnover rent might be more appealing sometimes.
Okay, so much to consider. And then there's that VT thing, opting to tax. What's the deal with that?
Sounds complicated, but essentially the landlord can choose to charge VA on their rent, but then they can reclaim VA they pay on property costs.
Yeah.
Impacts both the landlord and tenant, so you got to understand the implications.
Okay, so you've got the building, you've looked at the site, the lease, all that. How do you actually figure out what it's worth?
That's where these valuation methods come in. But first, remember, property valuation, not an exact science.
Right, it's about figuring out that market value.
Exactly. What a willing buyer would pay a willing seller, assuming everyone's being rational.
Gotcha. So let's jump into these methods. First up, the comparative method. Seems straightforward enough, right? Comparing to similar properties that have recently sold.
Yeah, the classic apples to apples comparison.
But there's always a catch, right?
Well, you got to factor in those little differences. Say you got 2 properties, same size, same location, but one has a garage. That garage adds value, so you adjust the value of the one without the garage upward.
So it's like judging apples A and D oranges. Similar, but not identical.
Exactly. You analyze those similarities, those differences, adjust the value based on what you find.
Okay, makes sense. Now let's move on to the valuation approach. This one sounds more complex.
It does have a few variations, but the article focuses on the all-risk yield approach, which is popular with investors.
Okay, so yield, that's a key concept here.
Absolutely. Basically, you look at the net income a property generates, the rent minus expenses, and calculate a yield. It's like a rate of return. It tells you how much income you're getting back on your investment.
Gotcha. But the article mentions drawbacks, especially when the rent isn't at market value. How does that work?
Imagine a property with crazy low rent compared to similar places. That's under-rented. Might seem like a steal, but the valuation's based on that low rent, so the yield might be artificially high.
So you have to look beyond the current rent. Think about potential rent increases. The article mentions this word reversionary. What does that mean?
Reversionary refers to when the lease ends or there's a rent review. Then you can adjust the rent to market conditions. So a property with a low rent today, that's a reversionary situation, might be a hidden opportunity to increase rent later, boost your yield and the property's value.
Interesting. It's like finding hidden treasure in the lease terms.
In a way, yeah.
The article gives an example of valuing an office building using this yield approach. But what about when rent is super high or fixed for a long time?
Those are tricky. Over-rented property, meaning rent's way above market value, it's going to be less attractive to investors, the income doesn't justify the price, and long-term fixed rents. Risky, especially in a rising market. If rents go up, you're stuck with that old lower rent, missing out on profits.
Yeah, I can see that. So we've covered comparing to similar properties and analyzing yield. What's next?
Let's move on to the residual method. This one's often used for development land. It's all about projections, potential.
Getting a little speculative here.
A bit, yeah. Imagine you have a vacant lot. Can't just compare it to other empty lots. You got to consider what you could build on it, how much profit that would bring. That's where the residual method comes in.
So how does it actually work?
You estimate the value of the completed development, that's the gross development value. Then you subtract all the project costs, construction, financing, marketing, everything.
Yeah.
What's left? That's the residual value of the land itself.
Sounds like a giant math problem with all those projections.
It is. And the challenge is you're relying on predictions about future values, future costs, which can be uncertain. The article has an example to illustrate how it all works.
Okay, 3 methods down, 2 to go. What about the profits principle? Sounds intriguing.
Think of a historic landmark or a specialized factory. Those are unique, right? Can't easily find comparable examples. That's where the profits principle shines. You look internally at the business to determine value.
So instead of market comparisons, you're digging into the company's financials.
Exactly. Analyze profitability. Gross profits, net profits. How efficiently they're using assets, that's the return on capital. And liquidity ratios, which tell you how easily they can cover short-term obligations.
So very specialized, requires a deep dive into the business itself.
Absolutely. Especially useful when the property's tied to a specific business,
Yeah.
like a hotel or a restaurant. The property's value is linked to the business's success, so you need to understand those financials.
Okay, 4 down, 1 to go. Tell me about the contractor's test.
Imagine this. You've got a property, no recent sales data, no comparable properties, and it's not tied to a business you can analyze. What do?
Sounds tricky.
That's when you use the contractor's test. It's about thinking like a builder.
So instead of comparing to other properties, you're asking, if we built this today, how much would it cost?
Exactly. You estimate construction costs, factor in land value, and account for depreciation. That's the decrease in value over time due to wear and tear, becoming outdated, all that.
So you're basically recreating the building on paper, but fast-forwarding to its current condition.
You got it. But the article does point out this approach can be subjective. Estimating costs and depreciation involves judgment calls, so it's not as precise as some of the other methods.
Seems like it's a last resort when nothing else works. The article uses valuing waterboard facilities as an example. Definitely unique properties. Probably not a lot of market data for those.
Right. It shows how the contractor's test works for specialized or really unique properties.
Okay, so we've explored these 5 methods, each with its own strengths and weaknesses, depending on the situation. But the article keeps going. It talks about 8 different ways to measure a property's value. This seems more geared towards investors, right?
Yeah, definitely. These are the key factors investors look at when they're assessing a property. It goes beyond just the basic valuation methods, gives a more holistic picture.
Let's quickly go through them. There's property age, location, investment size,
Tenant profile, building construction, holding period.
property quality, and ROI. Wow, that's quite a list.
It is, yeah.
It's like putting together a puzzle. You consider the property, the market, and the investor's goals to get that final valuation.
Exactly. And it shows that property investment is about more than just the numbers.
Totally. Some of these factors, like property quality, seem pretty nuanced. The article breaks down different classes of properties, from Class A to Class D. That's interesting.
Yeah, that classification helps investors quickly assess quality and risk. Class A, those are the shiny trophy assets. Skyscrapers in prime locations. Seen as safe bets, but come with a premium price.
Like the blue chip stocks of real estate. Low risk, but maybe not the highest returns.
Right. And then you've got investors who are comfortable with more risk. They might target Class B or even Class C properties, the ones that need some TLC, some fixing up.
The fixer-uppers of real estate. Potential for big returns, but more work and expertise needed.
You got it. It's about understanding your own risk tolerance and goals. Some investors specialize in turning around those distressed properties, almost a creative challenge.
That's fascinating, seeing potential where others don't.
And it ties into tenant profile, too. Some investors focus on attracting specific types of tenants, whether it's professionals in a residential building or big companies in a commercial space.
So tenant selection, it's a risk management tool. A stable tenant base can really make a difference.
For sure. And speaking of timeframes, it's wild how investor approaches differ based on their holding period. Some want a quick flip, others are thinking decades ahead.
That's where our holding period comes in. How long you plan to own the property shapes your approach to valuation and decisions.
Exactly. Short-term investor might prioritize quick improvements to boost resale value. Long-term investor might be more concerned with location, construction quality, that potential for appreciation over time.
Aligning your strategy with your goals.
Right. And remember, even seasoned investors might change their holding periods based on market conditions or unexpected events. Got to be adaptable.
Now let's talk about the big question, return on investment, or ROI. The article breaks down all these ways to measure it, each with its own quirks.
And the key is, ROI isn't one size fits all. Some investors focus on cash flow, the money coming in after expenses. Others might be more interested in the tax benefits, like depreciation deductions.
And for those looking at the big picture, there's the internal rate of return, or IRR, a more sophisticated way to calculate the overall return over time.
It's powerful because it considers the time value of money. $1 today is worth more than $1 tomorrow. The IRR helps you compare opportunities and make better decisions.
This deep dive has been so eye-opening. It's amazing how much goes into valuing a property, so much more than plugging numbers into a formula.
Definitely. It's about understanding the market, understanding people, understanding what truly makes a property valuable.
Before we move on to the next part of our deep dive, what stands out to you as the most important thing we've covered so far?
I'd say the fact that there's no single right way to value a property. The best method depends on the specific property, the market, and your goals as an investor. And those initial things we talked about, the building, the site, the lease, those are crucial too. They set you up for success.
Great points. And to our listener, we want to know, which of these methods or factors resonates most with you and your situation? Let us know. We'll be back in a moment to continue our deep dive into property valuation. We're back, ready to dive even deeper into property valuation. It's amazing how many layers there are to this.
It really is, yeah.
Yeah.
And it's fascinating how these seemingly small details can make a huge difference in how a property is valued.
Totally. I think it's great that we're going beyond just the formulas and looking at those qualitative factors that investors weigh. It paints a much more complete picture.
Definitely, yeah. Getting inside the mind of an investor, understanding what they're thinking, that's key.
The article talks about some interesting stuff about investor psychology, especially when it comes to different types of properties and the risks and rewards associated with them.
Yeah, like how some investors are drawn to those postcard perfect Class A properties, prime locations, top-tier tenants. They seem like sure bets, but often come with a big price tag.
Like, they're the blue chip stocks of real estate. Maybe not the highest returns, but they're seen as reliable and stable.
Exactly. But then you have those investors who are more comfortable with, well, a bit more risk. They might target Class B or even Class C properties, those diamond-in-the-rough properties that need some work, some updating.
The fixer-uppers of the real estate world. Potential for big returns, but it takes more work, more expertise to unlock that value.
Right. And the article talks about how some investors actually specialize in turning around these distressed properties. They use their vision and skills to make them desirable and profitable.
That sounds almost like a creative challenge, seeing the potential where others might not.
It is. And it shows that property investment isn't just about numbers. It's about understanding markets, understanding people, what makes a property truly valuable.
And that brings us to tenant profile, which the article also mentions as a key factor for investors. Some investors really focus on specific types of tenants, like professionals for residential properties or established companies for commercial spaces.
Yeah, tenant selection is a big part of managing risk. A stable, reliable tenant base can make a huge difference.
It's amazing how investor perspectives on time can be so different. Some are aiming for a quick turnaround, others are playing the long game.
That's where holding period comes in, right? How long you plan to own the property. And that time frame influences every decision the investor makes.
So a short-term investor, focused on a quick flip, might prioritize cosmetic upgrades to boost the resale value, but a long-term investor might be more concerned with things like location, the quality of the construction, that potential for appreciation over time.
Exactly. And you also have to remember that market conditions can change, unexpected things can happen, so even experienced investors might adjust their holding periods.
Adaptability is key.
Definitely.
Now let's talk about ROI, return on investment. The article breaks down all these ways to measure it, each with its own little quirks.
And it's important to remember that ROI isn't one size fits all. Some investors are all about cash flow, that steady stream of income after expenses. Others might be more interested in tax benefits, like depreciation deductions.
Right, those tax benefits can be substantial. And for investors looking at the bigger picture, there's the internal rate of return, or IR.
The IR is great because it considers the time value of money. Helps you understand not just how much profit you make, but how long it takes to make it.
This has been so insightful. It's clear that property valuation is a multifaceted process. It goes way beyond just crunching numbers.
Absolutely. It's a blend of quantitative analysis, qualitative judgment, market understanding, even a bit of psychology.
What stands out to you as the most important takeaway so far?
For me, it's that reminder that property valuation isn't an exact science. It's about choosing the right methods and factors based on the specific property, the market conditions, and what the investor wants to achieve.
I agree. It's about approaching each property with a discerning eye, recognizing that what works in one situation might not be appropriate in another. This deep dive has been fantastic, and I know you're gaining some valuable insights too. What are your thoughts on the idea of using property valuation methods for purposes other than investment, like property taxes or estate planning?
That's a great point. While we've been focusing on investors, these methods have much broader applications. For example, when local governments are figuring out property taxes, they use similar methods to determine the fair market value of your home.
That's a great example. And in estate planning, understanding the value of real estate is essential for distributing assets fairly.
Exactly. And think about things like divorce settlements or insurance claims. Accurately valuing property is often at the heart of those processes.
It's amazing how these concepts we've been discussing go way beyond just investing.
It really highlights how understanding property valuation is a fundamental skill, no matter how you're involved with real estate.
It's fascinating how those valuation methods pop up in so many places, from everyday property taxes to, big legal situations. It really shows how important it is to get how property values are determined.
Yeah, absolutely. Whether you're buying or selling, inheriting, even just living in a place, understanding these ideas can help you make better choices, protect yourself.
It's like having a secret decoder ring for real estate.
I like that.
Knowing these methods and all those factors, it's like you can see past the surface and get the real story behind a property's value.
And like we've been talking about, it's not just about the numbers. You have to be a bit of a detective, put together the clues from the property itself, the market around it, even figure out what buyers and sellers are thinking.
We've covered a lot in this deep dive, from the specific methods to those big picture things investors think about. What are your final thoughts for our listener who's been with us through all this property valuation stuff?
I'd say approach property valuation with a curious mind. Don't just take numbers at face value. Dig deeper, ask questions, get different perspectives.
That's such great advice. Like anything else, the more you know, the better you can handle the tricky parts and make good decisions.
Exactly. And remember, real estate is always changing. Trends shift, the economy goes up and down, new technology pops up. You've got to stay informed and be able to adapt.
So to our listener, keep learning, keep exploring, and keep that curiosity going. We've just scratched the surface here, but hopefully this has sparked your interest and given you a good base to start from.
Don't forget, we've got some great resources in the show notes if you want to learn more. And as always, we love hearing from you. Any questions, insights, or even ideas for future deep dives, let us know.
Until next time, happy investing.